You're probably going to make the same mistake that 8 out of 10 Canadian women make with life insurance. And it's not whether you buy it, but when you buy it and what you buy. Here's what I mean. Last week, a 29-year-old woman came to me and said, term insurance or permanent insurance? I just want protection for my kids just in case I unexpectedly die while they're still dependent on me. And that one question is the difference between a low-cost, short-term risk policy and a higher-cost, long-term risk policy, lifelong risk, with extra benefits. And by the end of this video, you should know exactly what type of insurance fits your situation, how much coverage you actually need, and the 3 things every woman should know before she actually talks to a life insurance agent. Life insurance is different for women in Canada, not only because they're most likely to outlive their male spouse, but also because they're more likely to be single parents, the sole breadwinner, or the caregiver of an elderly loved one or a disabled person in their household. And more women are realizing that they not only need to protect their ability to earn income during their working years, but that they need to be able to protect the lifestyle that their loved ones and their dependents rely on them for should they die unexpectedly soon. They also realize that they don't want to be a financial burden on those that they leave behind, whether too soon or later in life. And that relying on their spouse's workplace group insurance isn't always enough. Canadian insurance data shows that women tend to buy too little insurance or buy it too late when they might no longer be insurable or their monthly budgets don't allow them to cover the cost of high insurance due to their age. And they can often be sold the wrong product instead of being taught how to make the right decisions from a young age. So let's build this decision from the ground up. And we're going to start with one word that is very misunderstood. What actually is a life insurance policy? A policy is an agreement between you, the insured person, and the insurance company. You pay the premium with terms and conditions, and on a triggering event, the insurance company pays you or your beneficiary a benefit. So now we get to the decision framework, and there are 4 questions that any good life insurance agent or advisor worth their salt will ask you during your conversation, during your discovery call. And it helps if you already have the answers to these beforehand. So the first question is a 2-pronged question. Who am I protecting? What am I protecting? So let's start with the who. Am I protecting myself and my ability to earn income during my working years up until I retire? Am I protecting that ability from accidental injury or a severe illness that might take me out of work and will jeopardize my dependents, whether it's my kids, elderly parents, a spouse, somebody I'm taking care of, or a business partner? And if you're running a business and you have business overhead expenses, you have staff that you have to pay, and you're concerned that if illness, injury, accident takes you out of commission, that the business might fail, or you might have to file bankruptcy because you're worried about not being able to pay all of those bills and all of those obligations, then that's living benefits. So that's protecting you and your finances, your financial situation, if you don't want to have to drain your nest egg that you're working so hard to build so that it's there for you when you do finally retire. That's living benefits. Or am I protecting my loved ones, kids, spouse, roommate, business partner, a loan cosigner? Should I unexpectedly die before I have a chance to finish paying my mortgage or any other outstanding loans? Or do I want my business partner to be able to continue the business should I pass unexpectedly soon? That can be term life insurance if you answer yes to any of those. Question number 2. For how long do you want this coverage in place? Are you only concerned about your kids and having coverage while they remain dependent on you until they're 18 or 25? Or for the length of your mortgage, 10, 20, 30, up to 40 years, you can have term insurance that covers you for the life of your mortgage, plus extra that you can leave behind for final expenses. Do you just want coverage until you retire? Maybe you expect to have enough money when you retire to leave behind for the loved ones. You've already got a trust or a will in place that is ready to distribute should you pass after retirement. So, if so, term is probably fine. Or if you just want peace of mind coverage that's just always there in the background, lifelong until you die in your old age, then that is permanent insurance. All right, number 3. Question number 3. What happens if I get sick or injured and not die? This brings us back to living benefits. So you need to ask yourself, do I have enough savings and investments to cover me for 3 months, 6 months, a year, 2 years, 5 years, or permanently should I become disabled? Whether it's a temporary disability or a permanent disability and you can't work at all ever. Do you want to have coverage? How much savings do you have in place now to cover that situation? And if you're a business owner, you just have to ask yourself, do I have staff? Yes. Do I want them to get paid? Continue to get paid? Or do I want to let the business fail? Or do I want to declare bankruptcy? And the answers to those will help you determine which type or which term of living benefits policies you would benefit from. And the fourth question, which many people probably never ask themselves, is, do I want a savings component built into my life insurance policy, or do I want to leave savings and investments separately aside from my life insurance policy? This is an option. This type of policy is only available for permanent types of insurance. You want to ask yourself, do I want to keep everything separate? Do I want to keep my savings over here and my life insurance policy over here? Or I kind of like the idea of having a savings plan combined with a life insurance policy under the same policy. I'm willing to explore that some more. Also ask yourself if I would like to create an asset and build that asset while I have life insurance coverage on the same policy. You can also ask yourself if I am looking to store, grow, and transfer wealth I currently have safely and tax efficiently to the next generation, to my beneficiaries. And you can also just ask yourself, do I like the idea of diversifying my nest egg that I'm currently building to have other liquid funds available to me in my old age or retirement? And if you answer yes to any of these options, where you can combine savings with your life insurance policy, then you want a permanent policy. And if you're the woman who asks, do I want term or permanent insurance? I'm confused. Watch this section twice. Term insurance is a pure insurance. Permanent insurance has an accumulation component and a cash surrender value component. Term insurance is a fixed period. You pay for a fixed period, 10, 20, 30, 40 years, or anything in between. Permanent insurance is lifelong. With term insurance, once your term ends, your premiums will increase according to the age you have reached at the end of the term. With permanent insurance, you can make level payments throughout the life of your payment schedule, which means the same premium every month or every year. But you will also have the option to make a flexible payment schedule, premium schedule, where you create a maximum amount that you are ever willing to put into the policy, but you can still pay less than that in a year or a month where you can't quite make that maximum payment. So essentially, you have the option between level payments or flexible payments with a permanent plan. Term insurance is generally purchased and used for covering a mortgage, loan, any outstanding debt, or the gap in somebody's workplace group insurance plan, where there's not quite enough life coverage that actually covers the needs that we spoke about earlier. And a permanent insurance plan can do the same, but it also has additional components such as the accumulation component. You can also have access to compounding dividends and long-term liquidity available to you in later years of the policy's life. Term insurance is generally thought of using for a dependent's lifestyle continuity. Should anything happen to you, should you die unexpectedly sooner than when we all expect to die in our old age. And we have dependents that are relying on us. So we want to help them continue their lifestyle if we die too soon. And we're only paying for that for a short fixed period. And again, permanent insurance does all of those things, except it can be used for other purposes, such as another financial vehicle for gifting a child or grandchild with a financial foundation that's available to them once they turn of age or they're ready to go to college, for example. It's also a tool that's used for business continuity and succession. So let's say your whole family is in a business. You can have it all set up in conjunction with a will and an estate plan to make sure that the family business stays within the family if there is somebody in that family who wants to take on the business. Or if nobody in the family wants the business, but there's somebody maybe outside of the family who is ready to purchase your share of the business should you pass. And it can also be used, again, with the accumulation and the compounding dividend components to have liquidity available to you in your retirement, or just to have there as a cushion for old age care, long-term, to fund your own long-term care, since long-term care insurance plans generally are scarce in Canada. They're generally not available, or they have a very strict criteria that you must meet in order to get the benefits to pay out from a strict long-term care insurance plan. So this is another way to ensure your old age care. If you start it young enough and accumulate and fund it robustly over many years, you can have a very, very large asset that you can use to as a buffer for those reasons. And both term and both permanent, you can add living benefits add-ons. You can add disability income protection coverage, critical illness coverage, and accident coverage. Some insurance companies, not all, but the insurance company that I represent, Industrial Alliance or IA Financial Group, they do have a built-in feature, and it's called an accelerated death benefit. And what that does is it allows you to draw from the death benefit, whether it's a term policy or a permanent policy, and you've been diagnosed with a terminal illness and given a prognosis of 2 years or less to live, you can directly withdraw, accelerate death benefit as a payment to help you through that period. And one of the really good things about a term insurance policy, if you're just not ready to go for a permanent policy yet, you can convert that term policy into permanent. As soon as you buy a term policy, it doesn't cancel out your option to ever be able to buy a permanent insurance policy. In fact, it opens the door for you to purchase it later and already be guaranteed to be insurable for a certain amount of money. And with a permanent policy, there are what's called quick pay options where you can pay all of your premiums within a 10, 15, or 20-year period, depending on the type of permanent policy you're getting. And that's really nice to know, because otherwise you're just going to make payments until you're 100 or until you actually die. There are, depending on the policy, the type of permanent policy you get, There are other ways to pay your premium using the policy when you're later on in years and you no longer want to pay out of pocket or out of your other fixed income. You're not trapped into paying all the way up until end of life, but you also have options to make a schedule of 10, 15, or 20 years, and that's it. You do not have to pay another premium, and you're still permanently covered for life. And again, with a term policy, you can add a term policy to a permanent policy. So that is a really nice thing to know, because if you're really young, you can start your permanent policy nice and young, and you can add your term policy to cover your mortgage or cover your dependents while they're still under 18. And then once that term policy falls off, then your monthly permanent premiums also drop. With a permanent policy, you can add multiple term policies to your permanent policy, and that's typically done when you have different types of loans that end at different schedules. So one loan might end in 5 years, one might end in 10, one might end in 30. So you would ladder the term policies to drop off after each one, essentially after each loan has expired. So typically term insurance is useful for young families, single parents, roommates, loan co-signers, and business partners. And permanent insurance is great for all of those as well, but it's also great for seniors, families in general, solo professionals, or anybody who just happens to have a surplus of cash. They like the idea of diversifying their assets on top of all of their other financial assets they have in place. So here's 3 things that every woman should really think about before speaking with a life insurance agent. The first one is, what is your coverage gap? Now, if you speak to an agent like me, I actually will put together a financial needs analysis, and I can help you figure out what your coverage gap is if you don't know. And any other good life insurance agent will help you with that. And that can take some time, and it could take a little bit of financial probing. It might make you feel a little uncomfortable, but there's a reason for that, because we don't want to A, underinsure you, B, overinsure you, and C, it really helps bring home what your own financial picture looks like. And sometimes it's a bit of a jolt to people, and they realize where they might need to rein in some of their spending, or, oh my gosh, I have so much money sitting over here doing nothing. I could put it to much better use for me and my family and my dependents. It's a really good exercise to look at your overall financial picture. But before you speak to the agent, you can get an idea as to how much coverage you actually need with this quick and dirty formula that I've put together on the screen here. And it's not a hard and fast rule. Speak to another agent and they might have a different idea of what the formula looks like. But I like this one. To get your suggested coverage number, the formula is, and this is for term insurance, by the way, your annual net income minus your expenses times the number of years you anticipate needing the coverage minus your savings investments that you currently have, plus final expenses such as funeral costs, any outstanding debts, any future education that you want to have covered for your minor children, and guardian support cushion for your child if they're still under 18. Take that final number and times it by 1.3. So it's accounting for the rate of inflation every year at 2.5%. Question number 2 that you need to know before you speak to a life insurance agent is what you can afford monthly or annually if you want to pay annual premiums. Again, there's no hard and fast rules for allocating or determining how much anybody should be paying for insurance. I do have another quick and dirty formula to determine a 10% of your net income value. So it's really simple. Your suggested monthly budget equals your annual net income times 0.1 divided by 12 months. So that's your 10%. And take that 10% and consider, if you want living benefits, use 60% of that 10% towards your living benefits policies, and the other 40% goes to your life insurance policy. So when you have those numbers, you already know by the time you're speaking to a life insurance agent what your budget is for personal insurance costs. All right, and question number 3, what is your health status or your underwriting status? On a scale of 1 to 3, 1, your health is terrible, you've got chronic issues, you've already been declined by another company, you're probably not going to get coverage, but it's looking pretty bad. So that's 1 on a scale of 1 to 3. Number 2, your health, as far as you know, is fairly good, but you do have some issues in the past that you think might cause you to be rated or have to pay a higher premium for your coverage, but you're not sure. Or on a scale of 1 to 3, you're a 3 in that you're healthy as a horse, you have no worries, you've never applied for insurance, and you have no reason to think you would be declined. So on that scale, where do you sit? Know that number, be honest with the result of that. Be honest with which one you sit at. And be honest with your life insurance agent as well, because they will advocate for you. They should advocate for you and even do a pre-qualification test or questionnaire to make sure, based on your unique situation, that you can apply for a policy now without being declined. And that's what I do. I am an advocate for my clients, and I absolutely put together personal customized plans for everybody's unique situation. Now, we talked before a little bit about the savings component that you can get with a permanent insurance plan. So to understand the guaranteed savings a little bit more with permanent insurance, just know that the first priority in any case of getting life insurance is always to protect your beneficiary, whoever they may be. So first, you want to make sure we do all the math and answer all the questions to determine the coverage that you need for those situations, who you are protecting, before we look at a plan that has a savings accumulation, cash value, surrender value component to it. And last but not least, here are 3 of the most common mistakes and myths that come with purchasing life insurance. 1, I'll wait until I have kids. Otherwise, I have no reason to purchase life insurance. That's not a good idea because you don't know when you're going to have kids, and right now you're still young and healthy. What happens in between now and the time that you actually have kids could be 5 years from now, it could be 10, 20. You're older and you might have some health issues that have cropped up. So insurance might cost you a lot more if you wait until you have kids. And if you get it now, early, and you're already planning to have kids, now is definitely a good time to just put that buffer in place and get that rider or that option that allows you to add more insurance or convert to permanent insurance later. And another myth is that permanent insurance is always better because, well, isn't the whole point of getting life insurance to pay out when we die? And aren't we most likely to die after 60, 70, 80 years old when term insurance has already expired? Nobody can predict the future. We could die at any time. In that situation, if you're still waffling between the two, is to get both. Start with both. And the third most common mistake or myth is that people assume that they've already got a workplace group insurance plan, or their spouse has a workplace group insurance plan that covers them. Again, you might be surprised if you actually look into the coverage. It might not be enough. There could be a huge gap in coverage there for you. And if you do the formulas and answer the questions earlier in this video, you might find you don't have enough insurance. And secondly, that is not portable insurance. Anybody can lose their job. We cannot predict the future, but anybody can lose their job at any time. It doesn't matter how secure you feel. And it's happened to me. I've been laid off. I've been caught up in the quarterly budget cuts. And I know it can happen. And it can be utterly devastating just when you think your job is secure. Nobody has talked to you. You haven't had any meetings or sit downs or been put on a PIP. So as far as you know, everything's fine until one day you get called into the boss's office and you get that pink slip. Oh, what a shocker. And with that goes all of your group benefits. And now you got to start over. What happens if you're 50 years old when this happens? It's going to cost you a lot more. If that sounds like you, go out there right now, contact a life insurance agent. And if you're Ontario, that can be me. I'd be happy to help. And look at filling that gap now, starting your own personal and portable life insurance plan, even if it's just a small one, a term plan with the option to convert to permanent later. You want to do that because I have spoken to people in their mid and late 60s who both had corporate jobs their entire career. They had the workplace group insurance, and now they're calling me and saying, so we didn't realize that our life insurance would just disappear after we retired. And now we're thinking we need to get life insurance in place. How much is this going to cost me? And unfortunately, it can be cost prohibitive for the amount of insurance that you might need at that point in your life. And I don't want you to be in that position. I hate seeing people in this position because honestly, at that point, there's nothing I can do. So the best thing that I'm doing right now is I'm trying to help educate young women, young people, anybody. Don't rely on your workplace group policies as a secure way to ensure your dependents and your beneficiaries and your future. Whew. Okay, a little heavy. But if this video was the clearest explanation of what your life insurance options are that you've ever come across on YouTube, please let me know in the comments below and subscribe to this channel. And if you would like to see more content on any specific topic discussed in this video, let me know in the comments. And I've already got a living benefits video in the works. So if you want to know more about the different types of living benefits and how they work in conjunction with life insurance, subscribe to my channel and stay tuned.